What's going on, guys? Welcome back to the show. In this video here, we're doing a stock analysis on Nvidia. We're going to look into the fundamentals, the financials, and finally do a price analysis to determine a fair price to pay for this amazing business. My name is Leo, and my channel is dedicated towards all things investing. If you haven't done so already, hit the subscribe button. Anything mentioned in this video will have a link down in the description below. So if you're new here, you should definitely do what I just said. And it makes me feel warm and fuzzy inside. Without further ado, let's jump into Nvidia and dissect this business. So we're pulling up Nvidia here on the stock research tool, the most infamous software that I ever built, because it's the only software that I've ever built, and I can't even call it software. It's just a really deluxe Google spreadsheet here, but it will be an app, folks, so stay tuned for that. Now, what I like to do, folks, is first look at three different categories. So we're going to start off with the company metrics, and this is a little just rundown of where the company's been in the last 5 years, and kind of compare it to where it currently stands with the trailing 12 months category to try to gauge where this company might be heading. So Nvidia's got a lot going on here, and just to scan through these numbers quick, right? We got almost $650 billion company, so a higher market cap than Intel. It's in the same field, semiconductors. We got a high PE of around 70. Trailing 12 months, some improvement on our EPS, huge jumps in our return on equity, being 43 and compared to 34. Profit margin slightly up compared to our 5-year average. Revenue sitting at $27 billion with a net income of $9.7 billion. Free cash flow at $8 billion compared to our average free cash flow of $4.6 billion, folks. Keep in mind, $4.6 billion is our average, and we're pretty much double that, with a dividend yield of a very small baby dividend, if you want to call it, 0.07%, and we're easily able to pay that off because it's only $400 million of our free cash flow, and our free cash flow being at $4.6 billion on average, easily able to pay that off, no problem. Great return on invested capital. It's same 25%. Altman Z-score is phenomenal at 25.05. We want that over 3. Remember, folks, tech companies, and I've said this once, twice, numerous times before, when it comes to Altman Z-scores, keep it as a grain of salt. It's more so for tangible businesses. So Altman Z-score, whatever. Piotrowski score is 6. We want that between 8 and 9. 9 being the highest score we can get. 8's a great score. I would even settle for 7. We're sitting at a 6, so it is what it is. The metrics are looking pretty solid. I'm thoroughly enjoying this company so far based off of the high numbers that we're seeing. Let's go into our second category here, which is the financial evaluations category. No, that was odd. It took a quick second just to load up that list. So here's the financial evaluations category. We are marking this down as an 8 out of 10, folks. So based off the financial score, 8 out of 10. That is pretty high. And when the only point where we're losing marks is our PE 5-year average sitting at 53.87. We want that underneath 22.5. And our share dilution is slightly up at 1.46% over the last 5 years. Also very low. The last video I think I did was, Nike? And it was in the same categories. Honestly speaking, guys, these are probably the best categories to have no marks in. If they just stop issuing new shares, they'll get a point. But if this is the main discrepancy, the fundamentals are great. It's just that the company may be slightly overpriced. But we'll dig deep into that with the price analysis in a second. Let's run through the other numbers here first to try to determine where it's currently standing. We have a current ratio of 6.65, which is phenomenal. We want that over 1.5, and we are well above that ratio. That means they have a ton of assets on hand, and they can cover all their liabilities and have some left over. That's an amazing number to see. Return on equity average is 34.06%. We want that over 15, and we have that. EPS growth, as we indicated in the company metrics, there's been huge growth in the company. and we're sitting at 290, almost 300% growth. Well, look at that. On average, we're sitting at what, 1.93. Now we're at 3.91. It's amazing. And, a lot of this has to do with the surge, I would believe, with this whole, crypto mining and stuff like that. And listen, if you've ever tried to build a gaming PC in the last 5 or 6 years, you definitely would know the struggle, because trying to find a graphics card at proper price is like trying to find a unicorn. Just trying to find a unicorn. That's the only analogy I can give at the moment off the top of my head, because it's near impossible, because everything just got so blown out of proportion. And just keep in mind, for all my gaming folks out there, I'm running a 1060, so this is what we had to deal with. Anyways, I digress. So where was I? Huge earnings per share growth. Our debt to equity is at 43.92%. We want that underneath 50%, folks, because that just indicates that the company is growing through equity, right? They're generating equity within the business and not growing through debt. So what this indicates to me is that they got low liabilities on hand, low debt on hand, and that is phenomenal. We also have our net income is growing like by a ton. Our free cash flow is growing by an incredible amount. Our revenue is growing by an incredible amount, and our return on invested capital is sitting at 25%. We want that over 10%, well, 10% or higher, folks. And that indicates to me that Nvidia makes a great return on their capital and on their investments. Look, guys, this company so far hitting it out of the park. I mean, and rightfully so. There's been such a huge demand for semiconductors. There's a shortage. There's a metaverse that's coming out. The whole crypto space of people just mining Bitcoin. There's so much demand, and now I think they even partnered up with what company? With Lucid. They partnered up with Lucid for their self-driving platform. So there's deals like that are in the pipeline. Right now, they just released like their ARM-based GPU super chip, and they are making moves like crazy. So it's an exciting time to be involved with Nvidia, and if you're an Nvidia fan, there's a lot to be admired here. Needless to say, this company is great, but where does it stack on a proper evaluation? Because the two things that I've said that are going to be discrepancies are this 5-year average PE ratio sitting at 53, which is pretty high, and the slight dilution, but you know what? I can ignore that. It's at 1.46%. Now let's just see where it stacks. I thoroughly enjoy Intel. I believe that's the value play with the semiconductor companies. So hopefully this company is in there too. But something tells me, based off this little trajectory course right here, I feel like it might not be. So without further ado, let's jump into a price analysis to determine what is a fair price to pay for this business. So I'll just jump back in here so you don't have to see my big head too large taking up your screen here, and we're gonna look at this price analysis category. We'll do a 10-year evaluation because that's just my favorite number, because I think Nvidia is going to be around for the next 10 years and be larger and better. We'll do 3 estimates here: conservative, moderate, and aggressive. So we're gonna jump in. Revenue growth, the numbers we're gonna play with here are 3324-ish. I'm gonna ignore this 1-year number, and I'm gonna go with 20, 20.5, and 21. Profit margin, we're going to stick within, let's go same thing, 20.5, 21. Free cash flow margin, let's go 21, 22, 23, not that, 23. And price to free cash flow, I typically like to go with 14, 16, and 18, and a PE ratio of about 68, 86. Ooh, that's really ugly. So let's see, if I go 14, 16, 18, I'm just out of curiosity, let's just go into the revenue statement here. $26 billion, okay. $26 billion in total in trailing 12 months revenue. So, you know what? Over the next 10, yeah, you know what? 20, is that possible? 20%? So, yeah, I mean, I believe 20% revenue is definitely achievable. This might be a little bit too lenient. You know what? I might just bring it down to 18. and then 18.5 and 19. And you're gonna probably say, Leo, like that's a little bit too conservative, but and my go-to thing is this. I feel like I have to show my full face for this so you guys get the full effect of what I'm gonna tell you right now. Well, before I do that, make sure you hit the like and subscribe button if you're liking the video so far. Makes me feel warm and fuzzy. The software, as I said, will be available. If you're interested, send me an email. It'll be in the description below. Now, anyways, my point here is, with the revenue growth of being 18.5, and 19% going forward, the reason why I stick with these conservative numbers is because I want to be on the good side of wrong. Assuming this company does what I say it does and stick to these numbers, at least I know where my evaluation stands and there's that margin of safety. Now, hypothetically, it could do better than what I said, right? If it does better than what I predict, then hey, you know what? More power to me. And if it does worse, you know what? At least I won't be entirely too wrong. So let's put a desired return in. I like to go lucky number 13. And we are sitting at $150 a share, folks. This is that red number right there. So on the high side, we're hitting at 175, low side 150, conservative side 120. Average all these lovely red numbers here, and we got 148.36. So what that indicates to me is exactly what I was saying earlier. This high PE ratio will definitely affect that, because look, we dropped that PE ratio down by a considerable amount. And assuming these are the revenue numbers going forward for the next 10 years, keeping these same profit margins, you know, it's a great company. It's fundamental. Like, it's got a low debt. It's got a lot of things going for it. It's just mispriced ever so slightly. And I believe we had those prices not too long ago. When was the split? Oh God, never mind. So April 2021, and that was, I think that was way before. So this would have been like the split price where these numbers would have made somewhat sense. So here's the thing, folks. There's another one of these companies that it's great. It has a lot of things going for it. It's just mispriced. But I'm gonna put it on a watch list and see if it starts to go beneath the 170 range, maybe even 160 range. This definitely would probably be a buy on my, at least on my watch list. With this chip shortage, there's a lot of ground to cover, and you know, with the growing competition between Intel, AMD, and obviously Nvidia, right? There's a lot of room for people to share, and there's just so many things that are going on with this business. It's hard to ignore them. So yeah, my thoughts are simply that. I think Nvidia is definitely a buy once it hits the right price. At this current moment right now, I can't justify buying it just because I'll be paying for an overpriced business based off the metrics. But remember, you have to do your own due diligence. It's important that you take the right steps and dig deep into these companies. What the software shows here is definitely just the initial part here. Afterwards, what I would like to do is I would like to look at the team, see what the team's accomplished, the CEO and stuff like that, and try to dig deep into the business and see if this is worth owning. We're not there yet with Nvidia just yet. I'll put it on the watch list. Wait till a price comes out. Let's say if it's below 160, with if interest rates are rising, that will affect tech companies, and this company would probably definitely get hit. So something to keep in mind, as well as I believe they do a lot of their work in Taiwan with TSM, Taiwan Semiconductor. So with growing political tensions between Taiwan and China, you might see a lot of this business being done in the States. I have no idea. I can't predict the future. What needs to happen is that this price needs to go down, and then I would probably be a buyer of this company. Anyways, that's the video. Let me know what your thoughts are on Nvidia. Make some conversation. I enjoy when you put some stuff in the comments. Anyways, that's the video. Thank you so much for watching. I'll see you in the next one.